Ладно. Так, что ты там опять, блядь, собираешься устанавливать? Ну что, помчали? Так.
Guidance for the year, $2.5 billion in terms of loan loss.
Снижаем цены на мировые хиты. Супер скидки на самые популярные модели. Смарт-телевизор Haier со...
Dan Druckenmiller says equities risk rewards the worst he's seen in his career. You have David Tepper says the market's the most overvalued ever since 1999 bubble, and the list just goes on. Well, joining me now for her take is Amy Will-Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. Amy, it was like a who's who of high-named investors who are bumming everybody out with their negative outlook for valuation in the equity market. Is the options market pricing in any of that jitter?
So, good morning, first of all, Alex. It had been, and the fears were very high, and that's actually come in very quickly, and in my opinion, probably a little too quickly. We're probably going to start to see the options market reflate again. And what's been interesting this whole time to me is that all I'm talking about is the front end. So the long end of the options market, so how uncertainty looks in the future, has actually been very sticky. And my takeaway from this is this long-term nervousness is still there. So, we're going to be looking towards the end of May to get the full data on remdesivir. I think that's an important catalyst. I think how retail earnings do now, because they're a very high yieldy portion of the earnings market, that's going to be a big deal. But throughout this whole thing, the options market has remained pretty nervous in the, I would call it, 9 to 12 month bucket.
So then on the short term, how and when does that re-rate? Is it going to take retail earnings for the short end to sort of move?
Yeah, I would be watching those, and I think that this is a good opportunity because, option prices in the front end, just to give you two stats, from April 1st to now, the front end has dropped 30 volatility points. The long end has only dropped about 8. So that front end has come in very quickly, and now we have kind of two key catalysts to watch that could drive that downside. So if you're owning volatility now, I'd say that short-term one, especially ahead of these retail earnings, could be a really interesting place to place some short-term hedges.
On a sector basis, are you seeing where are the cheapest places to buy protection? Are you seeing on a sector basis any difference?
So, this is another point that I think is interesting. The parts of, and I'm just using the sector ETFs, but the parts that have come in the most are actually like some of the financials, IWM, and then S&P. And if you actually think about that, most of the underperformance has been more there than it has been in other places. So, for instance, IWM has come in, and then SPY, and then Qs. And those are sort of the opposite, the outperformance, right? So Qs, all your tech has just dramatically outperformed because of FANG. But the places where volatility has come in the most has actually been in that small, mid-cap, and value buckets. However, if we see continued bad news, probably that is where your beta is still going to lie, rather than, what I call the new COVID utilities, which is FANG and FANGman.
And talking about FANG for a second, there seems to be an emerging debate also over these names in tech, and that obviously we can understand why they may be more COVID-proof, but they still need to sell their services to companies, and those companies are getting hurt as they provide services for consumers, and consumers obviously can't do anything. Is it time to look at protection from that perspective or not?
I think the answer is yes. And, the longer this gets drawn out, the more you're going to start to feel that, despite, the, PAL put that has been placed into the market. One thing that we saw the last few weeks going into all the FANGman earnings that I thought was really interesting is this overwhelming call exuberance. So normally in the options market, call options are lower than put options in terms of their volatility because most people are long stock and then they're hedging. And in I would say 5 out of the 7 FANGman names, that wasn't true. So you actually had call implied volatility levels bid over put and volatility levels, which just shows you how much call exuberance there is. I mean, the only other stock I ever see that for is Tesla. So, it just tells you that they've almost reached this like cult-like, flight to safety, this is where people go when they have no idea what to do. And, I'd be taking advantage of that. So those calls being so big, you can sell that at a greater level to fund put protection than you could at any point in history. And actually Amazon, for the first time ever during the COVID crisis, its implied volatility levels as a ratio to the S&P went under the S&P. It was the first time that had happened ever in its history.
Interesting. Those are some really interesting comparisons. So I guess also what helps insulate tech is that it's unrelated to what central banks are doing, which leads me to what central banks are doing. I mean, you don't fight the Fed, you buy what they buy. That's been the mantra for years. And now that they're buying corporate bond ETFs, I wonder how that's playing out in the options market.
Yeah, I will tell you that has been something that we have looked at very closely. So I think it was Tuesday, the Fed basically started its secondary facility to purchase ETFs, which, just the fact that these words are coming out of my mouth is like kind of crazy to think about.
Mm-hmm.
And you know what I thought was interesting, specifically about HYG, is if you actually read the fine print, the Fed basically put in the high yield portion almost as an afterthought. It basically said, look, we're supporting IG bonds, we're supporting these specific IG bonds that have fallen angel status, but like only in this time period, and hey, we might buy high yield as well. And to be honest, I think the market took that, kind of out of proportion. And just if you look at the rally that happened after the Fed announced that, HYG had like the biggest rally that it had in months. The same with LQD, and now the facility has started beginning on Tuesday, and you've seen 3 days of HYG sell-off, and the options market has become extremely bid in the put wing. So the very low delta, very out-of-the-money puts have gotten very, very steep. We've actually been pitching put spreads there, so essentially saying, look, of course, don't fight the Fed, but, if this thing doesn't work or isn't seeming like it's working and it goes pear-shaped quickly, you're getting very, very good payouts on that downside now.
Really interesting. And then wrapping up with one more part, and that's the dividend and buyback story. If you were buying equities for buyback, that was not a good idea. And if you're buying it for dividends, that's now in question too. As the longer this goes on, the street's now talking about more dividend cuts. How does that play in to your overall thesis on the market?
So as a volatility person, one thing that I've been looking at very carefully is just what is fair value on the VIX and the VIX curve now. And I think, look, volatility is a mean reverting asset. That's what all the textbooks say. And my one nervousness about that is we're looking at the past 12 years of a bull market where a record rate of buybacks has dampened volatility, because when there's buybacks in stocks, it dampens the downside by offering an artificial level of support. I think 80% of companies during the last earnings have essentially said we're suspending buybacks and CapEx, and dividends are next. The people are trying to defend their dividends, but if they can't, then you chop the retail leg off the market.
Writing's not that easy, but Grammarly can help. This sentence is grammatically correct, but it's wordy and hard to read. It undermines the writer's message, and the word choice is bland. Grammarly's cutting-edge technology helps you craft compelling, understandable writing that makes an impact on your reader. Much better. Are you ready to give it a try? Installation is simple and free. Visit Grammarly.com today.
John, a tough time for the insurance market. I'm curious as to what your forecast breaks down to. So you were talking about $200 billion of losses for the industry, but that's underwriting as well as investment losses. Can you break it down for us?
Yeah, that's correct. I mean, tough time for our customers, and it's important that Lloyd stands up to be counted for the customers and pays its claims. So we've released our loss estimate today, but we've also estimated what we think the cost of COVID-19 is for the insurance industry globally, and that's just non-life insurance. So it breaks down really into about $100 billion that we think will be paid out over time in claims. So that's the immediate impact of the loss. It'll be the impact of the recession we're about to move into, and then the inflationary impact of recession on claims in the future. And then at the same time, as you know, insurers have their own investments. In effect, their money to pay claims of the future, and the asset value of those investments has fallen by about $100 billion. So all up, this could be a $200 billion loss, which financially, as you said in your introduction, dwarfs 9/11 or even Katrina or even Harvey, Irma, Maria in 2017.
Will it be a big event for the industry, though? David Havens of Imperial Capital pointing out just in the last while that the industry is backed by something like $2 trillion of regulatory capital. So the industry should be able to withstand this pretty easily, no?
Without doubt. So I think the industry is solvent. The capital the industry holds is substantially above its minimum requirements. So at Lloyd's, if 100% is what you're required to hold, we're in excess of 200%. So there's no doubting the industry's ability to pay the claims, but it's a significant earnings event for everyone.
It's also broken up by you into the various different categories. So, for example, event cancellation is about a third of the losses, property losses about a third as well.
Yes, it is. So for us, about 70% of the loss, and we've said up to the 30th of June, the losses within Lloyd's we think will be around about $4.3 billion or up to $4.3 billion. 70% in three categories. One is event cancellation, from the high-profile events of the Olympics that everyone will know about to more local events. And there's also quite a lot of property coverage. So where businesses have bought a form of property cover that responds to the pandemic, then we're saying about 30% of our loss will come from those claims. And obviously credit, where we back banks and financial institutions, there'll be a credit crush as well, and some of the losses will come from there.
John, can you go into some more detail about regions? Because the vast majority of your losses are in the United States and worldwide, 58%. I mean, compared to something like 15% for the UK, for example. Where in the USA are you seeing the most losses? What type of insurance?
Very similar, very similar. So we're not really a classic domestic insurer, so we're not a big insurer of businesses in the US. So the same categories we've talked about are those that apply in the US, but 50% of the world's flow comes from the US, so we shouldn't be too surprised to see roughly that percentage come out in claims as well. It's our biggest and most important market, and it's our chance, once again, to stand up and serve customers in the US to the best of our ability.
Well, you're also getting ready for the hurricane season, right? And the Atlantic hurricane season already almost beginning. What are you anticipating in terms of claims for the rest of the year, and how that will impact the business, given you've already sustained such losses?
Well, there's something very important about Lloyd's, and that is we recapitalize in real time. So recognizing the impact of COVID-19, we've already spoken to the participating insurers in our marketplace to recapitalize, if you like, reload in advance of the North American hurricane season. So our allowances are set aside for what we anticipate will be the loss activity from hurricanes. You never quite know, but we feel okay. We're certainly solvent, and we're able, I think, not only to fulfill our obligations for COVID-19, but for all the other losses that will occur, and perhaps even US hurricanes through the balance of 2020.
John, what is being looked for from your company, from Lloyd's of London, that you're not willing to do, if you like? So what kinds of claims are you fighting? What kinds of requests for coverage of this type of event are you fighting? We're seeing a huge argument here in the US between independent restaurants, for example, and insurers.
Yes. Yeah, it's very, very difficult, and I can understand the frustration from every quarter where, for many, and I think the majority, the business property cover does not cover interruption for this type of loss. It's a very
Yeah.
specific extension that some have bought, but many haven't. So I can understand businesses'
Мне кажется,
frustration.
это
My
будет плюс.
recommendation would be that they speak to their broker to really understand the cover that they've got and begin there with a discussion as to what they might be able to do. It's for that reason, actually, today, we've also released a paper discussing a number of ideas that we might be able to do to help. You know, if the pandemic comes back, then we should not find ourselves in this situation again. So we put some ideas down on paper for that, or
Yes.
even whatever the next event might be, if it's cyber or something even more sinister.
Yeah, I mean, these are interesting. I want you to go into some detail about this recovery idea in a
Yes.
moment. But is this, and I have to ask, is this an effort to be proactive so that you don't have to deal with any requests for back coverage this time, so that courts don't find that, maybe you do have a role to play in helping to restart the economy, even if it wasn't what was signed up for in the first place?
No, it's not. I mean, sadly, I remember
You're
the
welcome.
Ebola crisis and some of the fantastic products that were designed post that. There was a brilliant product called Pathogen X, which was a specific pandemic cover developed by Munich Re, the big reinsurer, in partnership with Marsh. Nobody bought the cover. So very, very sadly, when some of the covers have been designed, they just weren't bought last time round. So I think it's important that at a point where customers understand the value of insurance and maybe regret not buying cover they wish they had, that we ensure that problem doesn't occur again. So that's what we're trying to do. Sadly, where there isn't cover, there just isn't cover, and there's not much we can do about that. And that's really why governments are stepping in. But what we're trying to do is to say, can we stop this happening next time round to ensure that there are covers in place?
But isn't there, a role potentially for you guys in being the middleman? So with the understanding that the government might make you whole, you allow businesses to access liquidity and cash and so forth for now, so they can get up and running before they're no longer an entity, even before they no longer have any staff they can call on, or any expertise, or any supply chains, before everything goes to the wall.
So I agree, and one of the ideas you just spoke about, we call recovery, which is a sort of a prospective cover. There's a lot of talk of a second wave or possibly a third wave of the pandemic. So we're saying, how can you put cover in force for that now? And our idea is to look at a very long-term insurance cover, 10 years, 15 years, maybe 20 years, because clearly short-term, if the pandemic comes back, the losses will be very significant again. So an insurer would need to have a long-term cover to have confidence over time that there'd be some financial sense in providing the cover. So that's one of the ideas we put forward. We can't solve yesterday's problem, and that's why governments have stepped in, but let's try and solve the problem going forwards as we see it today.
John, how many quarters before your business gets back to something resembling some kind of normality? Prudential already saying that, forget about this quarter, and Asia is looking terrible. Nobody's buying any insurance products right now. So for the marketplace, what do you see? How many quarters?
So I think it's going to be difficult through 2020. I'd agree with that statement. And I think it'll be early 2021 by the time people have properly got their arms around the impact of the loss. But, I think the other thing, and it might sound a little incongruous to say this, but clearly if the industry will be suffering losses of $200 billion, then that unfortunately will have an impact on price. So prices in our industry will have to go up. So I think looking out and looking forwards, difficult though this is to say, often insurers do rebound quite quickly, and we've talked about those big events in the past, and you then tend to see a year or two or possibly 3 years of some very good results. So difficult 2020, a bit challenging into early 2021, but all things being equal, the outlook thereafter should be
Я
positive.
думаю, оно будет
John, how are you
расти.
preparing for people to go back to work? I mean, Lloyd's of London is notoriously one of the places where people, still
Yes.
do want to go into headquarters, into the offices. It's not exactly the most conducive to work from
Plus.
home environments that there are out there. So how are you preparing?
It's a great question. We've been doing fine from home, but we do need to be physically present as well. So one of the opportunities we've been working on anyway is modernising and digitising the marketplace. So when we do return, we'll be doing a bit of what we're doing today, working virtually and really as well. But we'll be driven by government permissions. So our plans really show a phased return to work, but we certainly don't see the famous underwriting room at Lloyd's opening before August. And even then, that'll be conditional upon social distancing and what we're allowed to do. But it's potentially 3 months away still. But we're trading electronically and we're trading efficiently at the moment.
I made a prediction in 2016. You might have ignored it then, do not ignore it now, because it turned out to be extremely accurate. And I've got a new prediction, so listen very carefully. What is that prediction I have for 2020?
Steve, the romance was great. Saks Fifth Avenue, the whole thing, and all your good competitors as well. Is it done?
Oh, I don't know if it's done, but it's certainly changing. And it's certainly a different world for luxury retail, but for all of retail. And a lot of the trends that were occurring before the pandemic are just simply accelerating. And you're going to see more and more consolidation, more bankruptcies, but you're going to see survivors as well. And those that survive, who do things differently, I think have an opportunity to still thrive in this environment.
How will they do that? How will they amend? How will retail amend given the new rules?
I think, first of all, they're going to have to look at what they offer, the experience that they offer to the consumer. The consumers clearly moved to an omni-channel world, and they may not want to go into the store at the same time as others do. Right now, you're doing curbside pickup, you're doing off-hour appointments, you're doing clienteling via apps, so that they still want the luxury products. The high-end consumer, if we're going to talk luxury, still really wants to be catered to. They want that unique, special, different Chanel or Louis Vuitton product, but they want to have it on their own terms. And the retailer has to understand how to meet those terms.
Steve, good morning from London. How much of luxury items are actually bought online? And is that trend just going to accelerate significantly?
Oh, it's clearly accelerating, and you're seeing marketplaces, you're seeing the resale, you're seeing brands that are going online. Remember, brands are creating their own stores. If you take somebody like a Gucci, they're probably 80% their own stores at this point, and online will become an increasingly important part of the experience. And even if you looked at a Neiman Marcus or a Saks, 30-35% of their business is already online.
I mean, are there too many luxury companies? I know Tom and I are both, not impartial to a bit of luxury, but actually we're oversaturated with companies. And is this a time where some will have to go bust?
Oh, I'd say that about all of retail. In the U.S., you've got 3 to 4 times per capita the amount of retail as you do in Europe. And there'll clearly be consolidation. Right now, the highly leveraged companies are having enormous issue. You see the bankruptcy of Neiman Marcus, J.Crew. I think JCPenney's on the verge of bankruptcy. So it's not just at the luxury tier, it's at all tiers of retail. Leverage is not the friend of anybody in a pandemic like this.
I look, Steve, at the path of every purchase, and you're world famous at this. How we actually go about doing a purchase. We see the item in a magazine, and then we decide to buy it, and there's a whole emotional process which you're expert in. Can Jeff Bezos get expert at that process? Can Amazon learn the way that we acquire the acquisition items we want to acquire?
Oh, I think they already are. I think Amazon's doing a remarkable job of tracking the consumer, understanding them. Part of what they're doing is they're looking at their marketplace in terms of what's selling, what's not selling, and then they're able to create the Amazon basics or whatever model it's, whatever brands they want from it. So of course you can do that, and how you track that consumer behavior and how you appeal to them is changing. It used to be national television advertising or magazine print. Now social media is driving it, analytics, artificial intelligence. The whole world of marketing has fundamentally changed, not just at the luxury sector, but at all tiers. Whether or not Amazon plays in the luxury sector is a separate question. I think you're going to see evolving marketplaces, and that's why with the Net-a-Porters and others, you will see marketplaces emerge at luxury. May or may not be Amazon, but others will play.
Steve, a delicate question. For those troubled in retail, not only the marquee names, but those competing maybe beneath the surface, is there enough wiggle room in the workout process of leases, what they pay for rent, to allow them to survive?
I think it's a great question. Your bankruptcy will allow renegotiation of leases. It'll allow closing of stores. The real question for any bankruptcy is, do you have a business model? Do you have a reason for being that's differentiated enough that's going to allow you to survive in the future? So many bankruptcies come out of bankruptcy and then they go bankrupt again because they haven't fundamentally changed the model or the experience for the consumer. Jury's out right now relative to the current bankruptcies as to whether or not their model is going to be able to be surviving. That's why you may need to have consolidations going on, because they might be better served consolidating or liquidating going away. But I'm not convinced that all of these are just going to be, let's close a few stores, renegotiate some rents, and then it's going to be business as usual.
Grammarly does more than catch errors. With Grammarly, you can find really good, no, perfect words that make your writing
just in terms of how quickly you get to 1 million. And then that all-important question, because we just heard a story about the EU having to turn back masks from China over quality. Where do the 1 million masks go? We know that Canada will lay some claim to some, but will they go to the U.S. as well?
Yeah, those are great questions. First and foremost, we've dedicated a portion of our Oshawa plant to build 1 million masks a month. We are currently right now training employees. We tend to start production here very shortly, hopefully later next week. And we should ramp up over the course of the month of May to get to that full 1 million unit mark in June and beyond. So where the masks go, we're working with the federal government here in Canada, and they are the customer. And we're going to give it to them to put them where they need them. So where they will go will be in Canada, but it'll be up to them to make that call.
Scott, I think we can assume that the mask you're wearing is actually a GM Canada mask, so congratulations. What did it take to refit the factory? How much, and what will it do to your bottom line in the coming quarters?
Yeah, so to refit the factory was an effort of a lot of great people, both here in Canada as well as in Michigan, where we had a mask operation already being put together. So we leveraged that skill set, brought it here, and did that. I would tell you that we know how to manufacture things. We know how to manufacture things in great volume. So it took a little bit of a learning curve, but pretty quickly the team got on it, and I think we're in a really good place. As far as the bottom line goes, we're doing this for the Canadian government, and we will be a supplier to them, if you will, and we're doing it at no cost to them, so we should be able to recoup the costs invested here.
And Scott, as we were expecting, we're hearing from Premier Doug Ford of how Ontario will phase in reopening starting on Monday. Under certain restrictions, a lot of retail will be able to be back in business as long as they have a curbside entrance, a street-facing entrance. That will include vehicle dealerships, new and used. And one thing we've heard from Mary Barra, your CEO, is that the path to full production will be dependent on demand. What's your read of how quickly that demand gets back to normal and you can get back to normal?
Yeah, that's so we've been working hard with the governments across the country to keep the dealerships open as a essential business. We've had to adjust our model in most provinces. We've been able to do that. So dealers are now selling online in Ontario by appointment only in Ontario. So it's really turned out to be a pretty amazing thing to watch as the volume starts to pick up here in the month of May, much greater than it was in April. And dealers have done some things here that, quite frankly, I think will be the new norm going forward. So much more convenient for customers to do the transaction online and have that vehicle delivered to their home. So I see some of this stuff sticking with us for the better good of the customer going forward.
Scott, have you had to put measures in place to help any of the dealerships more than you typically do?
To help, I'm sorry, I didn't get the question.
To help the dealerships, say for example, financing and so on. Have you had
dealerships.
to do? Mm-hmm.
Yeah, that's great. Yes, there's been a lot of efforts here to to help the dealers. We've shared with them our protocols very open and transparently, so they can learn from what we know about putting operations back in place. Our financial arm, General Motors Financial, has done things to help with their payments on inventory as this business has been hit pretty hard here in the last month and a half or so. And many vendors have stepped up to help dealers as well as the government with small business activities. So there's a lot of things that the dealers have been able to take advantage of. It's been tough for them, but they've been pretty resilient, and seeing business come back in May has been really good.
Scott, we've seen obviously different jurisdictions handling reopening differently, and that is very true, Canada versus the U.S. The border and how it reopens is still a very much live issue. We know that your business, of course, has been deemed essential, and presumably, as needed, things will move back and forth across it. But has it added complexity as you consider getting back up to full manufacturing here?
Not necessarily. As you mentioned, we've been deemed essential from the get-go, so we made the decision to take our manufacturing operations down in March, but we always have had the opportunity to do business when we were ready to, and that's starting to happen with our supply base this week, and as you mentioned, our assembly plants next week. So the border, our materials are flowing as they should, so it's been good.
There's a pencil, right? That's all I need is a pencil, or a piece of paper would come in handy, and I'm going to write some dialogue, and it's going to take place in one place with two chairs, and that's all I need.
You lay out the track of your belief of L-U-V exclamation mark, the love opportunities. I want to know where you're leaning into, L-shaped recovery, U-V, or the exclamation mark. What has the greatest propensity at the moment in the HSBC house?
Well, if you look, economists came out with new forecasts, and you were talking about other houses coming out with new forecasts. No one's revising up. When we're talking about the U.S. economy falling on the annualized basis in the second quarter, 45%. I mean, that ain't no V, baby. So it's much more looking like from our economist side, a U or an L-shaped, and that's why we talk about love, the L, the U, the V. And I think this V's out of the question. Of course, purchasing manager surveys are going to go from 5 or 7 back to 30, but 30 is still a U. So yes, we're going to get a bounce. I mean, these numbers are single digits. It's crazy. So we're in the depth, the bottom pit at the moment. But the point is, of course we're going to get a rebound. Of course there's pent-up demand and things like that. But how long is it going to take for the level of the economy to get back to where we were before the virus? And we're talking some emerging markets not even in 2 years. That looks like a U to me.
Yeah. David, the V scenario is the one scenario where you see the dollar losing out. And you've just said that you think that an L and a U is much more likely. So therefore, how much longer does the dollar reign supreme?
Well, the dollar will reign supreme in some of the, as you said, when we move off this risk on, risk off. That's where we are at the moment. We wake up, we look at the equity market. If it's down a lot, we risk off. If it's up a lot, we risk on. And that's how we are at the moment. But we're going to gravitate, as you say, or you suggest, we're going to gravitate towards one of these letters. And once we do, then the whole vista of foreign exchange changes, and the dollar will weaken a bit. But that's still a little way out. I mean, I wouldn't be too premature. The dollar's still the king of the pile.
The dollar's still king of the pile. I like that. But you talk about Ro-Ro as being at levels that still are reminiscent of the global financial crisis. That's 12 years ago. In that scenario where Ro-Ro remains the dominant theme, where does the dollar excel? Does it excel against the yen? Does it excel against the euro? Where's the strength of the dollar most manifest for you?
Well, the strength of the dollar is most manifest if we're on a down leg of the V against emerging markets. They've been absolutely smashed to pieces. I mean, we're talking about, some of these countries having currencies, down 25, 30%. The South Africas, the Brazils, the Mexicos have been and the big game changer for EM is they're cutting interest rates into a currency crisis, in a sense. And that is a game changer. Historically, emerging markets raise rates when their currencies are going down, but now they're cutting rates, they're doing QE, so they're saying we don't really care about the currency for the moment. And so those currencies are under massive downward pressure, massive.
I'm really glad you brought that up, David, because I have asked a few people recently, including Mark Mobius, precisely about this, the fact that in a lot of EM, QE is going to be used, if not already, to fund budget deficits. And I've asked whether that's going to put downward pressure on currencies, whether it's going to lead to capital outflows. Some people have said to me, no, we're not worried about that. It sounds like you are.
What do you mean they're not worried about it? Who are you asking? Who are you having on your show? You're not... I mean, obviously you've been downgrading the show having these people on. Come on. What are you talking about? Emerging markets cutting interest rates basically towards the zero bound and doing QE while their currencies are falling 25%? You've got to be kidding me. Of course it's negative for these currencies. They're being absolutely smashed. But should they care? That's a different question. Should they care that the currency is falling? Because usually you care that the currency is falling because it'll create inflation. And inflation creates higher food and energy prices, and that squeezes the real incomes of poor people. So you raise interest rates and you protect the currency and you protect poverty. But if there's no demand, there's no inflation, so you might not have to defend the currency. That's a different story, whether you should or you shouldn't. But the currency's under pressure. They're cutting rates while the currency's falling. They're doing QE. Of course, there's massive downside pressure and further downside pressure on these EM currencies. I don't know who you're speaking to. For goodness sake, you should have me on the show more often.
Поздравляю! Ваша тачка официально заряжена.
И как вы так быстро все успели?
Обижаете? Мы ведь все-таки профи.
А комфорта добавили? И управляемость улучшили?
Как договаривались.
А безопасность?
И это учли.
What do you think about getting back to pre-pandemic price levels in the housing market? Is it going to be a quick trip, or is it going to take some time?
I think, Matt, good to talk to you. Good to be here. I mean, you know what we've seen in the UK, both in terms of the housing market, but also in terms of the commercial market, is an extraordinarily quick reaction. So what took 5 quarters in 2008, 2009, in terms of impact on property markets, both residential and commercial, has taken 5 weeks in 2020. So we anticipate that volumes, the amount of activity in markets, both residential and commercial, in this quarter will be lower than anything we saw in the global financial crisis, and pretty much the market in terms of anything new has stalled for the last 2 months. But we are now we've just had some government announcements this week that the housing market can start moving again. We can start carrying out inspections, carrying out surveys, opening residential sales offices. So that's going to be the real focus of the UK market over the next month or so, getting that all moving again. It's going to take people time to get comfort, though, that now is the right time to buy. So I think it will take some time for pricing in the residential market to come back. But I think longer term, looking out over the next 2 to 3 years for both residential and commercial, I think we can still be reasonably positive. But the short scale shock is huge.
And Chris, can I ask you about the commercial side of things? Obviously, how much less will you be investing in office space now versus other things? Because there are alternatives, you know, student housing, senior living, supermarkets, warehousing, distribution. Will the business increasingly focus on those things and not office space because of the trends we've been seeing in recent weeks?
I mean, I think it's a really interesting question, Anna. And I think we and a lot of our clients were thinking about that the whole time. And I think in terms of those longer term trends, it is still a little bit early to actually define them with any clarity. So we're focused much more on scenarios. We've been looking at in terms of 3 phases: respond, and then recover or re-entry into the office, and then reimagining the future. So what the respond phase has shown us and many other organisations, and I was just, when we were talking just prior to that with Matt and you, Anna, that some of the big financial organisations are thinking, what this has done, it's busted a few myths. It's busted myths that you can't work pretty effectively remotely at scale. You can carry out trading functions, you can carry out investment functions. But what I think the debate now is around what is the place of the office in the future. So although we can carry out a lot of the very efficient working remotely in terms of offices, there's a lot that you can't do remotely. And I think the office will need to, it's not reinvent itself, but I think COVID will be a catalyst for themes and trends that have begun to start. They will be speeded up significantly. So I think offices are going to have to become the creative hub, the ideas factory where innovation takes place, where you have collaboration, you have connection, where you have the physical and social interaction. But I'm also absolutely sure that we'll see more flexible and more agile working. And so the balance between working and working in offices, I think that's going to change.
Так нечестно, последний свечку поднял.
I still think offices got a big place in the future.
Тут был правильный прогноз.
Is there a silver lining, though, with fewer offices being occupied by workers? I know you work with a charity called Crisis, which fights homelessness in the UK, and surely that's going to be a problem because of the financial disaster that we're looking at right now. Do you think there's a possibility that we can find solutions, better solutions to that after this crisis?
Well, I certainly hope so. I certainly hope so, Matt. I mean, I think one of the interesting things around the crisis is how companies and organisations have come together with communities and charities like Crisis. So certainly we're doing quite a lot of work now around the hotel sector, which is hugely impacted, and we're looking at engaging with Crisis, with both hotels and other occupiers, to accelerate initiatives around homelessness. So I think the response of industry has been encouraging there. But I think one of the other big themes that we've begun to see pre-crisis was the importance on health and well-being for organizations around their workforce, around their workplaces, and not just physical health, mental health. So I think all of that links back actually in a way to what we were talking about with Crisis. So I think the workplaces of the future, it's going to be really more important that actually you're really looking after your people, and that you're looking after the communities that you're actually involved in serving with as well.
Что ты там мне про свой пенсил опять будешь рассказывать?
Чувствовать себя комфортно в своем доме и быть окруженным красотой.
Mario Greco, thank you so much, as always, for giving Bloomberg a little bit of your time. The Allianz chief executive spoke to us last week, and he says the industry has been hit by a meteorite. What are people talking at the board level about the transformations that the insurance industry will go through?
Good morning, first of all. Look, the insurance industry is used to catastrophes.
This is what we do to protect and repair damages brought by natural events, and the pandemic is a possibility. And we have been preparing for this for many years. Of course, when it happens, you're never fully prepared, but as it appears today, we cannot frankly complain. I mean, we are fully operational from the beginning. In January, we shut down our offices in Asia. We continue working from home, and so we tested all our applications and the capabilities we had from Asia. And then when we started in Europe, we confirmed that we could perfectly work from homes, from remote. And then we extended this to US too. Financially speaking, we wanted to give today an indication to the markets of what's going to be the impact in terms of claims. Of course, this is our estimate as of today. It will change over time, but again, it puts this in the framework of a natural catastrophe, which is something that as insurance managers, we are prepared to manage as soon as it comes.
Do you think it will lead to any strategic changes for the industry? So either in the way that, I know you said, you've dealt with these kind of huge natural catastrophes in the past, but will it accelerate consolidation? Does it change, in the way some of the industry operates and some of the companies operate?
Yeah, look, I think it will depend on how prepared you were when this happened. So we were extremely strong at the end of last year. We concluded a 3-year cycle exceeding all targets. So we were financially strong. Our capital was one of the highest levels we had in the last years, and morale engagement of our people were very high. Customers' satisfaction was also very high. So we're taking this as not a change in the long-term view we have, but it's something that we have to overcome in the short term. Anyone who was less prepared and less in a healthy state at the beginning of this will have a further struggle. And so from that respect, yes, it can lead to changes, but it's early stage today to understand. We want to wait and see what happens. For sure, we'll be there when this will be over, and we will be ready to, run the business at full speed when this will be over, and we'll see about everyone else.
Is there anything that you've done on the investment side to try and mitigate some of the losses?
Not really. I mean, I don't think you can mitigate the losses. Again, it's about being prepared. Our investment portfolio is very prudent. We don't take big bets, big risks. We balance out very well the exposures we have, so we don't have huge exposure to anything. And we remain like that. And frankly, we have no regrets yet. Again, we have seen this crisis or similar situations before, and I think we know how to behave in these situations, and you should not react with panic, because panic makes even worse consequences.
I mean, I understand that you've seen it before, but I guess the size of this and the fact that it's so global is, something that makes people worried. What kind of economy do you base your assumptions on? Is it, a big recession and then a slow and patchy recovery? I don't know whether, you look at a V-shaped kind of recovery, or how that filters through, how you're managing your business.
Yeah, I know the debate on V-shapes and the form of the letter there. I'm not going to get into this alphabetic discussion, but we do expect that U.S. and China will start showing growth in the second half of the year. We expect the Q2 will be probably the bottom of the crisis. And we think that especially the economies that react faster, like US and China, will start rebounding in the second half of the year. We do expect a recession, and a significant recession. And we hope that Europe will take the proper actions to contrast the recessionary crisis throughout the European economies.
Mario Greco, and you have said, look, you've seen this before, especially with some of the natural catastrophes, which were huge for the insurance industry in 2017. What do you see as the main difference? I mean, this is a health crisis, but then I guess the economic consequences or the suspension is also man-made. So can you talk us through how this will play out differently to 2017, for example?
Yeah, you're very right. So the health crisis, by this extension, hasn't been seen for a number of years. There is memory in the organizations of many years ago, but it was many years ago, and no one has a direct experience of that. The most important thing today is to manage the health crisis and give confidence to people that their lives are not at risk. And this is something that governments have to do, but also companies have to do. We have taken steps with our employees to start providing them with the tests to understand who has been exposed and how. And we've been shutting down the offices, as I said, very early on. So the health crisis is the priority. The financial consequences of this can be fought and should be fought by governments with actions to relaunch the economies and to support the economies. Clearly, these actions will create debt, and this debt will remain and eventually will be the lasting issue of all this over the next years. But it's needed and it's helpful. And I praise the governments who have taken immediate actions, as some European governments have done, and definitely US and China have done themselves.
So you were also saying that you switched 55,000 employees and working from home very quickly in a short amount of time. Do you think it'll be difficult getting those people back into offices, or is it going to be much more flexible working hours? How do you think about the getting back to work like we used to 3 months ago?
Yeah, that's a very good question, Francine, because what we discovered with this crisis is that actually we might not need to rush to go back to offices because we're functioning very well from home. There is something you miss if you work from home, but our industry can really continue working from home without too many losses of efficiency or opportunities. The thing you miss is the human interaction and the fact of seeing by near other humans, and some of us fear that more than others. But from the standpoint of serving the customers, resolving their issues, providing them what they need, we can continue doing that from home, and so we are not in a hurry to come back to the offices.
Do you think it will change the workplace in general?
I say this being at office today.
Yeah, I was just going to comment on that. In general, do you think a percentage of your employees will continue staying at home for a long time? I mean, almost forever?
Yes, I think so. Well, not necessarily, not because they have to, but because we discovered that this is a possibility and it is an effective possibility. You can work well from home. And so, yes, I think that will remain as well as, we discover also that you don't need to travel so much, which, by the way, is very helpful for the planet. So there are very good positive lessons out of this situation, and we are taking them as they should be taken very seriously.
Снижаем цены на мировые хиты. Супер скидки на самые популярные модели. Смарт-телевизор Haier со скидкой 8 тысяч рублей. Холодильник Haier со скидкой 19 тысяч рублей. Узкая стиральная машина Haier со скидкой 11 400 рублей.
know it's been less than a year, really, since you've joined KKR, raised $2 billion, more than $2 billion at the beginning of this year. This is your second investment from that fund. Interesting about Slice is that you announced this deal last night, just hours after Bloomberg reported that Uber was looking to buy Grubhub. How can Slice, which works with 12,000 pizzerias across the nation, how can that compete with something of the scale of Grubhub?
Sure, and thanks so much for having me. So this was actually the fifth investment out of our second fund at NGT. And we are hyper-focused on businesses that we believe can be category defining. And I think our vision as it pertains to the Ubers and the Grubhubs of the world is that Slice is focused on the independent pizzeria first. And they believe there's an opportunity to provide real value and help those independent pizzerias compete in a digital world for a digital consumer against the big pizza franchises and the horizontal food aggregators. It starts by providing value to them, and it ultimately does it by delivering at a significantly lower cost.
Right, but as an upstart, what kind of resources may it need to compete with the likes of a Grubhub in this day and age, especially as Grubhub and DoorDash have so much of the delivery market?
Sure. So first and foremost, this is the pizza industry is a highly fragmented. So there's over 75,000 locations in the U.S. today, and over 50,000 are independently owned. A significant percentage of that are outside of major dense metropolitan areas. And what Slice does better than anyone is provide value to the independent pizzeria and then charge them literally a fraction of what Uber would to provide their product. And so I think it starts with a better value, a better solution, and ultimately does it at a significantly lower price.
Jake, I suppose I'm still struggling to figure out why another delivery company is needed. Most independent pizzerias have their own delivery people. They won't have to pay, up to 30%, I'm not sure what Slice charges, but to an independent delivery company, right? And what are you getting out of it? I mean, what kind of return on investment are you looking for out of Slice?
No, that's exactly right. Delivery has always been part of the core value proposition for independent pizzerias. Think your local hometown pizza shop. But what they don't have is the digital resources to compete. And so what Slice has done is created a end-to-end technology platform that's vertically specific for pizzeria. It comes from a foundation, Elir Sela, who has 34 members who have worked in and operated pizza stores. And it allows them to be online. It allows them to do the things they can't do on a daily basis. Manage a website, build a website, optimize SEO, take payments, attract new consumers and existing consumers through their application, which has been growing tremendously over the last several years. So we think there's an opportunity to create a vertically specific app and a vertically specific solution to this group of small business owners in a way that Grubhub and others just aren't focused on.
Jake, you must be absolutely chomping at the bit because valuations have changed dramatically over the last few weeks. Where are the opportunities now to pick up, basically what might be distressed kind of investments in Silicon Valley right now? And what is the future?
Sure. So we've got a slightly different focus at NGT, and in our KKR Growth Fund, we're looking for category-defining, category-leading assets that have great management teams. We're looking past this dislocation for long-term sustainable companies. So rather than sort of discount or bargain basement shop, we're truly in our fund looking for great companies, and we're going to continue to do so. And we believe, although this specific pandemic has been an extraordinary tailwind for Slice, we believe it's situated for real long-term differentiation.
Speaking of this being a tailwind for Slice in this environment, is the COVID crisis creating opportunities and investments you may have not otherwise seen? Are you changing your investment thesis in any fashion because of what's happening right now?
No, we're not changing our investment thesis at all. Although, again, we closed 2 deals in the last 2 weeks, both of which we've been establishing a relationship with and we'd entered into conversations with before COVID hit. But both the pandemic is highlighting the need for both. So never before has there been a greater need to support our small businesses and provide them tools and solutions to continue to perform. Slice is doing exactly that. And we invested in another business called 09 Solutions, which is an end-to-end demand planning and supply chain business. And as we all know, this pandemic has revealed a number of things, one of which is the dysfunction of our global supply chain. And we believe 09 Solutions is truly the next generation provider in this space. So again, we're looking for, this is a fund that we closed in January. We've got a very long-term perspective with just under $2 billion of dry powder. Our focus is to find, invest in, and support great teams and long-term winners.
So with $2 billion in dry powder left, how can we see that being put to work? Is slice a typical investment for you, or are there specific criteria you're looking for here as you're putting that money to work?
No, Slice is a great example of exactly what we're looking for. We spend most of our time in software, internet, information services businesses. So you'll see us, looking for high growth businesses with great management teams. If and when we can, we'd love to invest in these businesses outside of broad banker-led processes because we've spent years developing a relationship. And I think the relationships that we've been developing, proactive origination efforts to find these great companies over the last 5 to 6 years will hopefully benefit us in this period of dislocation and distance. We're going to be, working hard to support the best names that we've met, the best management teams we've gotten to know over the last few years, and I think you can expect a lot more of that. But we're going to be sticking to our guns. We're going to be looking for great category-defining businesses where specifically KKR can help. We think we've got an extremely differentiated global platform with a tremendous amount of resources that have been built over the last 44 years, and we want to bring that to the best growth companies in technology.